Sure. I think the net impact is that small and medium or niche banks are going to be under profitability pressure for quite a while. Some of them still have ongoing liquidity or solvency concerns. Some of the largest banks are pretty much in good shape. They don't really have the same types of risks. And that's kind of the arrangement that they're in. The Fed has been pulling liquidity out of the market, over the course of the past year, and I think they've kind of run into roughly the limit of how much they can pull out. And so, their balance sheet has been down for a year. I think it's probably going to be sideways-ish for a period of time. Whether it has to shoot up again will depend on if there's another shoe to drop, another sort of like liquidity crisis. It's partially, psychological, basically whether or not humans do a bank run or not do a bank run. So some of that's unpredictable, but I think the general base case is for somewhat of a more sideways liquidity situation and a kind of a slowdown in terms of how quickly they can raise rates and pull down their balance sheet. I think it's a phase change from going straight up with tightening. So they basically balance sheet constantly down, like Fed balance sheet, and rates constantly up. I think it's a trend change towards somewhat sideways in both of those. I think the balance sheet's probably going to be sideways-ish for a period of time, and I think rates, they might get a little higher, but I think the rate of change is slowing down, and they're kind of getting closer to their peak. And that's relevant for markets. It's obviously relevant for liquidity sensitive assets, Bitcoin, gold, other assets like that. And it's generally pro equity when it happens. But I think a lot of that might be behind us now. If you go back to the September 2019 period, there was a similar event. It wasn't as severe, but basically there was a repo spike. And basically the interbank lending market kind of broke. The Fed had to come in, and that marked the end of their quantitative tightening. Basically, they ran into the liquidity floor for banks. And the main difference was that back then it hit big banks, whereas this time it hit small, medium banks. And last time it was not accompanied by all these big unrealized losses because there was no record increase in interest rate. And somewhere between Arthur and Ben would be my position. Not where Ben is. Similar to Arthur, but I don't think my base case would not be 1 million Bitcoin in 4 years. And then I'm pretty far from the 90-day hyperinflation scenario.
Okay.
The way I would characterize it is the reason I'm fading the left tail is because I don't really see the balance sheet going straight up, anytime soon. Even though I don't think it'll keep going down. That's why I kind of refer to it as sideways. And in fact, in the past week, we've seen the balance sheet go down a little bit, but that's of course off after 2 weeks of very big gains. So it's still much higher than it was 3 weeks ago. And if you look at that yeah, exactly. There it is. And if you look at the Fed, if you look at the repo spike back from 2019, what they did was there was a pretty rapid increase in the Fed balance sheet for a number of weeks. And then it kind of trended sideways for a period of time, all the way into February of 2020. And then, of course, we all know what happened next. There was the March COVID lockdown crash and everything went vertical. And, that was a different scenario. But if that had never happened, the Fed probably would have remained sideways for a longer period of time. And so I think we've seen a trend change. I don't think that trend change is going to be straight up unless there's some other big, psychological issue. Now, when you look out further, I do think this has implications because basically I think the long run outcome here is that the Fed will reach a limit where they're unable to keep tightening while inflation does have a resurgence in the years ahead. And I think that is a pretty pivotal change for hard assets, for kind of anti-dollar trades, which is maybe where I probably would align at least somewhat with Arthur on that based on your description. As for liquidity versus solvency, I think that's very bank dependent. So that is a big difference. 2008 was a very solvency related issue. Basically, banks made loans and those loans were defaulting. And they had very, very thin capital, very thin cash, so they couldn't take much defaults. In this scenario, banks have a lot of cash and treasuries and mortgage-backed securities, basically very safe assets in general. They've not made very aggressive lending decisions, but their mistake was buying these otherwise safe assets at very low interest rates that have long duration. So if interest rates go up significantly, those get marked down if they have to sell them between now and when they mature. So it's like you're guaranteed to get your money back, but if you have to sell it before that happens, you could be out of luck. And Silicon Valley Bank had two sides that were extreme. On one hand, they made a very big bet on these long duration assets, right? There are other banks that were more conservative, like JP Morgan, for example. In addition to being as big as they are, they also were careful about getting into long duration assets too much. They balanced their book better. Whereas Silicon Valley Bank was far on the side of like, let's just buy all the long duration stuff, right? So they're getting killed on that side. And then two is your deposit risk, right? So Silicon Valley Bank also was an extreme there, which is they catered mainly to businesses. And so the vast majority of their deposits were uninsured because of the size of individual deposits. And they also were obviously very concentrated into a handful of industries in a region. And so their deposit base was very flight worthy. And so you have the combination of those two was very toxic. And so they were a outlier in terms of their risk. Now, there's other handful of banks that are close on one metric. So for example, First Republic did not have quite the same asset side problems. But it had a similar clientele of very high uninsured deposits, and it still had long duration kind of illiquid loans. And so that's a problem for them. Less extreme than Silicon Valley Bank, but still a problem. On the other hand, there are, for example, Charles Schwab is one of the biggest brokerages in the country, and they're technically insolvent right now. And you wouldn't know it by looking at the stock. And so they actually have a similar problem as Silicon Valley Bank, where they bought a lot of long duration assets at low rates that they're now underwater on, and those exceed their capital, right? So they're negative. What makes it different so far, at least, is that less than 20% of their deposits are uninsured, and they have a much broader, diversified base. And they're Charles Schwab, so they're perceived as being bigger, safer, probably backstopped as if needed. Yeah, I think a middle of the road outcome makes sense. I think particularly liquidity sensitive assets, it's generally a plus for them. But in terms of assets that actually make a profit, I still, the overall recession or not picture is still very relevant. The profit margins are relevant. And so we can kind of divide the economy into almost like two sections. There's ones that are interest rate sensitive, and that includes obviously real estate due to how leveraged it is, and it also includes unprofitable tech companies because they're reliant on issuing equity at very high valuations, which is easier to do when interest rates are zero and harder to do when interest rates are 5%. And so basically those are the two areas that have been under pressure. I think they're going to continue to be under pressure. Whereas there's like travel companies, restaurants, other areas that are virtually unaffected. They're not really showing any sort of economic deceleration. And then there's a bunch of things in the middle, like manufacturing and other things like that have shown deceleration, but not to the same degree that you've seen in, say, real estate or unprofitable tech. And to the extent that the market is pricing in kind of a top in terms of Fed rates, maybe the first half of this year, maybe a bottom in liquidity, that's generally good for, say, scarce assets that don't have to worry about profits. Historically that'd be gold. Now it's Bitcoin and similar assets where those types of things don't really have to worry about recession, but they do have to worry about liquidity conditions, and those have changed.